Does it make sense to take a loan from a high cash value life insurance policy when the rate is 5 to 6% when I can get a better loan rate elsewhere? Have you ever had that question? We get this question quite a bit, meaning if I've got a policy that is maximized for cash value, should I borrow from it at 5 to 6%? Or if a better opportunity exists where I can obtain a loan at 2 or 3% because interest rates are oh so low right now, should I do that? What are the pros and cons? We're going to go through just that today. So with a policy, first we're going to look at a life insurance policy loan. We're going to assume the policy is designed for maximum cash value here. And I've got $100,000 in cash value, a dividend rate of 6%. Now, with a cash value life insurance policy, once $1, so if I have $100,000 in cash value, once that passes through the cash value, regardless if I just let it sit and grow and earn that dividend of 6% indefinitely, whatever the dividend rate is, or if I decide to borrow against it, I will continue to earn that 6% on my entire cash value. So how a policy loan functions is like this. If I've got $100,000 in cash value, I borrow out $50,000. What happens is I am still going to earn that dividend of 6% on the full $100,000 as if I never touched it in the first place. The $50,000 I've loaned, there is a cost to borrow. We'll assume that the interest rate is 5% in this example, and that 5% loan interest cost, that expense, goes to, not myself, to the insurance company. So the disadvantage right now in this very low interest rate environment is what? A 5%, especially a 6% loan interest rate, can be high, and I am paying that to the insurance company. A lot of people have expressed that. I felt the same in many cases, depending on what I'm looking at or what you're looking at as far as an investment or decision you're making, and you want to utilize your policy for that decision. The advantage, however, is control. When I take a loan from a life insurance policy, yes, I have the word loan there, but payments are 100% in the policyholder's control. Whether I pay the interest, whether I make principal payments, if I've loaned everything out, often I have to pay at least the interest if I'm not making premium payments or anything like that. But if I have cash value in there, in the majority of cases, I've got control of everything as far as how and when I attack that loan on my policy, and if I attack it. A lot of times people don't pay back loans. So again, the advantage here, control, versus an outside loan. So if I have cash value of $100,000, earning a 6% dividend, same thing as over here. We're going to assume we've capitalized the policy. So I've got a policy here, and I take a loan from an institution for $50,000. We'll assume the loan interest rate is 3%. This goes to the lender, whoever that lender might be, whether it's a specialized lender, a bank, whoever it is we're working with, it goes to them instead of the insurance company. Now, payments are often due monthly, and I have terms set by who? That lender. Meaning control is in the hands of the lender. Depending on the type of the loan, can they call it? What's the rate, the interest rate look like? Is it variable and such? Life insurance policy rates can be variable as well. We've got more information on that. But here are the key differences. Policy loan, I've got control, but a higher cost to borrow, versus an outside loan. I can obtain a loan at a much lower cost to borrow, lower interest rate. However, I give up a degree of control. The thing I want to emphasize, however, is this is often the same. The policy is going to perform at the exact same level, especially if it's a non-direct recognition contract. Meaning if I have a policy where I pay money in and just let it sit and grow, and I borrow money out, I'm still going to earn that 6% dividend on the full $100,000, even though I've loaned money out. So if instead of borrowing directly from my policy, if I just approach a cash value life insurance policy in the sense to say, hey, here's a safe, liquid, tax-free area I can position money. It produces between, call it 4 to 5%. It's there no matter what happens in the market. The economy keeps going up. It's great. So I can borrow directly from it or just let it keep growing and leverage it to obtain a loan elsewhere. Now, this is great conceptually. As always, let's look at some examples here. We got to have some fun, right? So here we've got a policy on a 58-year-old male looking at some larger payments, but we're going to look at, he's going to consider a potential real estate transaction. That's why these payments are so large. So he's got $500,000 per year going into the policy for 5 years. Here's my payment, $500K per year. Has the option to keep paying, but does not. 58-year-old male, breaking even between years 3 and 4. That's what is highlighted in yellow here. Let's make this a little bit bigger here. There we go. Then we've got the annual internal rate of return. This represents what he is earning each year, his net after-tax return. This is a tax-free yield after the company's insurance expenses, mortality charges, all of that good stuff. And then we've got the average internal rate of return as well. How I like to explain these two, annual IRR, if I'm going to compare it to the S&P 500, what did you earn last year in the S&P 500? 8%, 15%, depends on the year. The average is what did I earn the last 30 years in the market, if I'm comparing it to the market. Most people are familiar with that. The average will always be lower than the annual. However, I see it average out a little over 4% with no risk, tax-free growth on the policy. Okay, that is great for a policy, for an area to position my money other than a bank account, which might earn 0.4%, depending on the bank and how much money I've got with them. Now, let's look at a direct policy loan here. So this guy shows the exact same policy, $500,000 for 5 years. Cash value over here, but the loan interest rate here, we're going to borrow out $500,000 for 4 years. He wants to take out a total of $2 million for a real estate transaction. He wants to take it out as quickly as possible instead of one lump sum, so he spanned it out over 4 years. He can do whatever he wants here. Here's our loan balance, loan interest cost, or loan interest I should say, interest rate 5.66%. Then we've got the interest payment. So each year the loan interest is due, he is paying that out of pocket. So the first year pulls out $500,000. The loan interest cost, $28,000 and change. This is why we see the interest payment at $28,000 and change. So he pulls out the $2 million. After that, begins to repay it at $500,000 per year, plus the interest payments out of pocket. So what we did here, because I want to factor in I want to take into consideration, I should say, the fact that he's made interest payments each year. So what is his total interest cost here on the life insurance policy? Yes, he is still earning dividends on his full cash value compared to the growth example we saw over there. So another way to put it is he's still earning dividends on his entire bucket of money, and he funds in cash value and the outstanding loan balance. This is why when it's repaid, the last $500,000 loan repayment, I see my cash value restored. So I've continued to earn interest all the way through. With that said, how much did I pay in loan interest? About $450,000. That's a hefty amount. Depending on the policy size, how much I'm paying in, how much I'm borrowing out. I mean, he paid 5.66%. That was the loan interest that went where? The insurance company. So this individual looks at the situation, this could be you, and you say, all right, the advantage here was I had control. I could pay that loan back however I want. I could decide not to pay it back, and then if I sell my property down here, when I'm 75 years old, I can just pay off the loan at that point in time. You can do that kind of stuff with a policy loan because, again, you have control. You determine when you make payments. You can set it up to have monthly payments, but you're not required to. Flexibility, everything is in your court, not the lender's. All right, so next let's take a look at the cash value collateral loan. So what this is going to entail is utilizing a cash value life insurance policy and going to a third-party lender, an outside institution, solely to obtain a better interest rate. So what we've got here, exact same policy on the left, growth, $500,000 for 5 years, 58-year-old male, breaking even between years 3 and 4, which is great. Annual internal rate of return and average internal rate of return, exactly the same as the last slide, the basic policy with just growth. But we're going to compare this to leveraging the policy to obtaining a loan outside. So a cash value collateral loan, we've got additional video content on this. Basically what I'm doing is taking a policy, assigning my cash value to a bank or a specialized lender and obtaining a loan from them, often at a much more attractive interest rate than what I can obtain directly from the insurance company. Now, there's pros and cons to this. The number one thing is we do give up an element of control, but if I'm working with a bank, often I've got to jump through several loopholes, providing tax returns, potentially credit checks. I'm working with a bank, so I've got to go through all of that documentation and that process. There are specialized lenders that solely focus on cash value collateral loans that are not banks, so the process, the ease, call it, of working with them exists. So a lot of people are attracted to them in that respect. So it's a nice option to have in addition to a policy. Now, if I want to add this, if I use a policy for a cash value collateral loan, what happens is I do assign a portion of my cash value as collateral to them. So there's a collateral assignment, which means it prevents me from making changes or accessing the cash value in that policy. I can, but they're going to have to sign off on it first because the collateral for them to give me that loan, which is typically a line of credit, it works a lot like a home equity line of credit. To obtain that, the cash value is that collateral. They want to be protected in that respect. So here's our loan, identical to the last example, $500,000 for 4 years, a total of $2 million. Here's my loan balance. Annual interest is much less because the interest rate is 3.25%. This goes to the lender, not to the insurance company. I do not touch the cash value on my policy. The money is not pulled from my cash value life insurance policy. I'm simply saying, Mr. Bank or institution, here's my policy. I'd like to assign a portion of this as collateral to you, just like I would with a piece of property in order to access the equity in my real estate. Very similar in that respect, only this is guaranteed to go nowhere but up over time. So again, there's my interest rate. These vary depending on who I'm working with. Interest payment, so just like the last example, I am making interest payments here. Then I repay the balance at $500K per year, just like the policy loan example. Now, if you recall, what were the interest expenses, the net interest payments on the policy loan sample? A little over 450 grand. Whereas this guy, net interest payments, $260,000. The lower rate is the reason why I'm paying less. So the advantage here is I save on interest cost. If I look at my internal rate of return, I'm outpacing that loan interest cost, especially after the first few years. If I look at the average, it takes between 8 and 9 years. If I look at the annual, year over year, about year 5. Point being, I can outpace the cost to borrow there and have a positive spread. A lot of people are attracted to that. What I give up is a degree of control. With this, typically have interest-only payments, and there are terms to that loan. Now, in the event that a lender calls the loan, what would you do? Borrow from the policy, pay off the loan, and you're back to where you started, to where you would have been if you just borrowed from the policy from the get-go. Let's look at a quick comparison here. There we go. So this might be a little bit small on the screen, but we're comparing the policy loan sample to the cash value collateral loan sample. Let me try and do this real quick and just make this a bit bigger here. A little better. Trying to put too much on the screen at once. Okay, so loan and repayment sample. Again, this is a direct policy loan. So here, what do I have? Complete control. We've worked with a lot of individuals that look at the rate and say, hey, I don't care what the loan interest rate is. Like, I want the convenience. In a sense, I'm willing to pay for the convenience. It makes things easy. I request the funds and they hit my account within a few days in most cases. So it's very convenient in that respect. But if we also look at the interest rate and say, okay, well, I am perfectly fine and willing to make interest payments to an outside institution. If that's my flavor, if I'm good with that, if I'm comfortable with it, and I'm going to save almost $200,000 in the process, a little bit less, sign me up. So the main thing here is not to say one's better than the other, period. Because from a numbers perspective, right now this is more attractive. From a convenience standpoint, this is more attractive. And as time passes, things will change as far as a policy loan being more attractive, depending on where interest rates are and such. The purpose of this, like all of our videos, and if you work with us, you know this, and we'd love to work with you if you're considering working with us, but the purpose of this is to provide awareness and different options. If I know about this and I'm comfortable with making payments outside to a different institution, sign me up. If I'm only aware of this, okay, it can work, but if I'm kind of stuck on this piece, the interest rate, and I wish I could get a better rate elsewhere, this is a good option to be aware of. So, policies, I've got control. Outside lenders, better interest rate often. Hope this helps. If you have any questions, reach out and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.